Welcome to Future You, where your growth drives our community. With me today is my pal, 20 plus years in the industry, Andy Fulton. Andy is going to tell us a little bit about what's going on in the market. Andy, I feel like I say this every time, but it is just the truth right now. A lot's happened in the last week. Tell us what's going on with the Treasury and all the other things.
Thank you, Andrea. This is usually a slow week in our business because it's the 4th of July week, but it hasn't been very slow for us recently because we're experiencing something new. If you just look at a real quick chart on the 10-year Treasury yield, this is the US 10-year Treasury yield, and just look at kind of the tail end of this chart, what we've been experiencing over the last few weeks is a drop in US Treasury interest rates. And mortgage rates don't directly follow them, but they follow the US 10-year Treasury quite close. Why is this happening? For a few reasons. One, we've been in kind of an environment of global trade concerns with new tariffs and negotiations with other countries starting to calm down. The markets really jumped mortgage interest rates because they didn't know what to expect. They weren't sure if prices of goods and services were really going to increase because of these negotiations and these new tariffs. And so far, we really haven't seen a lot of that in the economic data. In fact, the most latest inflation reports are really not showing much impact, if any at all, on these tariff negotiations with other countries. But that doesn't mean that it won't eventually show or hit some of our price of goods and services. President Trump has been really frustrated with the Federal Reserve chair because he has not started dropping interest rates yet. He thinks they should. The Federal Reserve chair has kind of held steady and came out with some comments last week saying they're going to wait a little bit longer before they potentially start dropping Federal Reserve interest rates until they see more and more of what the impact actually will be if we do experience new tariff negotiations with countries. Just in the last few days, the president has come out and said that he's going to try to put a shadow Fed president into place. And what that would mean is there's somebody else starting to communicate into our communities and our markets of what they think interest rates should be doing. And that person's probably going to have a different opinion on who our current federal chair president is. And it could create what it's going to likely create, at least for investors in the bond market, is some maybe hope and confidence that when there is a change in the Federal Reserve chair, which will happen next summer, that the new person coming into that place will start to drop interest rates if they haven't already been done that time.
Andy, is that something that's typically done with a shadow Fed president? It's the first I've ever heard of anything like that.
I've been in the business for 28 years. I haven't seen it before, but we're living in new times. Let me go a little bit further into interest rates. So where the US Treasury yield is doesn't necessarily represent where current mortgage interest rates are. Mortgage interest rates typically in the past were about 1.5% to 2% higher than the current US Treasury rates. But you can see here just for the last 2.5 years, and I've got an arrow pointing to 2025, they've been more in that 2.5% to 3% higher of an interest rate than the 10-year Treasury. And let me make that real simple, right? If the US Treasury rate's 4%, in the past, you typically see a 30-year fixed rate mortgage at 5.5%, maybe 6% compared to that 4% Treasury rate. But in the last 2.5 years, we've seen it be more in a 2.5% to a 3% difference, meaning that if the US Treasury's at where it is today, around 4.2%, we're seeing mortgage interest rates between 6.87% and 7% APRs right now. Why has it been elevated for the last 2 years? Well, a couple reasons. One, after the financial crisis of 2008, the US government was one of the biggest buyers of mortgage-backed securities in the secondary market because they needed to maintain the liquidity in the markets so that home buying was affordable, mortgage rates were liquid, and they were affordable for clients through a real financial crisis about 15 years ago. They discontinued buying those bonds right around the beginning of 2022 or middle 2022, and that created a supply-demand change in mortgage-backed securities in the secondary market. So that 1.5% to 2% difference is elevated to about 2.5% to 3% difference. But one of the things we think might happen here in the foreseeable future is the U.S. government's also potentially talking about relaxing some of the strong requirements on banks on how much money they have to keep on deposit for day-to-day transactions for their clients' checking and savings account. They may lower that requirement on what they have to keep on deposit day-to-day, and that will allow banks to become a bigger investor in the mortgage-backed security secondary market. So it's a big thing to watch. It's a little nerdy to talk about, but what it tells us is we could potentially in the next few months, even in the next couple of years, experience more demand on the mortgage-backed security side. That would bring us back to that more 1.5% to 2% rate difference between a treasury rate and a a 30-year fixed rate mortgage, meaning that, interest rates in general wouldn't have to move much at all for treasuries, and you'd still see mortgage interest rates decline.
So break that nerdiness down for me. What does that mean to our home buyers?
I think mortgage interest rates could get a little bit more affordable for home buyers, but let's remind everyone, I wouldn't wait to buy a home because you're thinking interest rates are going to drop maybe 1/4% or 0.5% in the next year, because the home's probably going to be more expensive if you wait and buy it then. And quite honestly, you don't have to keep the same mortgage for the life of the home when you own it. You can always refinance it. So home ownership is the number one way Americans build net worth. And you want to get into a home, especially if you feel like you're ready and it's within your budget, as fast as you can. And then let's manage the mortgage interest rate through refinances over time. And my guess is we're going to see quite a few people refinancing sometime in the years to come. We just have no idea when.
Awesome. And there's more to just the interest rate, right, when you're buying a house. So tell me a little bit about what's going on in the form of closing costs. Are there any updates, anything you want to share?
Yeah, thank you, Andrea. We got a really helpful report from a reporting company called Lodestar just a couple months ago. And that report showed us where national closing costs were for buying a home and obtaining a mortgage. So let's just start with the average national sales price in 2024 was about $438,000. And the average closing cost, which includes everything, the recording fees and the taxes that you have to pay when you close on buying a home, were about $4,600 for the average person, just a tad over 1% of the sales price. But there's a lot of variation at the state level. You can see in the state of South Dakota, which was the lowest state on the report, it's only about 0.5% of the sales price. And in the state of Delaware, you really need to plan for your closing cost on a mortgage to be about the cost of 3% of the price of the home that you're buying. To just look a little bit deeper into the report that again came out from Lodestar, and we'll put this link in our video, you can actually review where, if you're in a certain state, what are the average closing costs in your state. And if you just kind of eyeball this, you can see a lot of variation depending on what state you're in. And a lot of this has to do, does the state charge intangible taxes on mortgage transactions? And do they have an elevated requirement on, let's say, surveys for the home or other needs that maybe some other states don't have?
That's amazing information, Andy. In today's world with ChatGPT, you are my ChatGPT. So thank you so much for breaking down what's going on in the market today. And for all of you that are watching, that's what we're here to do, is we're here to break down information in the mortgage world right now and to help make things more explainable and more attainable in general. So if there are other things you'd like to learn more about, hear about, please drop it in the comments and share this with your friends. Thanks so much for coming. See y'all next week.